Welcome to the 3-Edge Week in Review for the week of November 27th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. This week, Steve and I will discuss how the consensus on Wall Street has shifted rather dramatically away from the Fed needing to keep interest rates higher for longer to the belief now that the Fed is done raising interest rates and will begin to cut rates as soon as the first half of next year. And we'll explore how Fed rate cuts might be either positive or negative for the capital markets and why. Before we get to that, a brief look at the activity in the global capital markets this week. And now we've come to the end of November, and it was quite a month for just about every asset class. Here in the U.S., the S&P increased by over 8%, and ex-U.S. equities also moved higher. Japanese equities increased by approximately 6% in November. In the bond market, the price of 7 to 10-year U.S. Treasuries increased by over 4% as yields on longer maturities declined by over 40 basis points. And lastly, the price of gold rose by over 2.5% last month in what you might describe the month as an almost everything rally. However, not to throw too much cold water on last month's performance, it is important to keep in mind the S&P has still not gotten back to where it was in January of 2022. So despite all of the excitement over the past almost 2 years, the S&P is basically flat over that time. So let me bring Steve in here now. And Steve, as I mentioned earlier, during November, the consensus on Wall Street has certainly shifted and shifted rather dramatically, from the narrative of the Fed was going to need to keep interest rates higher for longer. And now the narrative that seems like everyone has adopted is the Fed is done raising interest rates and calling for Fed rate cuts as soon as May of next year. So first, why don't we talk a little bit about why the consensus on Wall Street has changed so dramatically? And why are investors so enthusiastic about this new narrative?
Well, we've seen this month, it's been a tremendous bout of investor exuberance and enthusiasm, and the markets have shown that. So there has been building this market consensus toward what's been called an immaculate disinflation. And what that really means is that instead of inflation staying higher for longer and interest rates staying for higher or longer, inflation will come down to its target without putting the economy into a recession, without raising unemployment. And it'll just happen by itself. That's got everyone excited that then the Fed can cut rates as it follows inflation in its decline. And that's going to be great news for the markets, because as the bond market anticipates the Fed rate cuts, bond yields decline, which we've already started to see in November. That creates lower cost of capital. That creates less competition for stocks. That means that since we're avoiding a recession, the economy can continue to grow, corporate profits can continue to grow, and people who have been left out of the market now have FOMO, fear of missing out. So they've been piling back into the market in a big way. And this month we saw that. And FOMO is a psychological factor. And we know from past bubbles that can last a while. So we could get a test of the previous bubble high that, as you mentioned, was back in very early January of 2022.
Okay, thank you for that. So now I have a two-part question. So the first part of the question deals with, I guess, the old adage, be careful what you wish for. And that question is, okay, so if the Fed begins to cut rates in the first half of 2024, I think it would matter as to why they could be cutting rates in the first half of 2024. So that was my first question. And the follow-on, or whichever order you want to answer them, the second part of the question is, could you speak to what has actually occurred throughout market history following that first rate cut by the Fed after a period of monetary tightening?
Well, Fritz, I think you're absolutely right. It does matter why the cut happens. Throughout history, nearly every rate cut that's happened has been preceded by talk of soft landing. This is not new. This is very common. And instead of a soft landing, we typically get a recession instead. So think back to 2001, 2002. There was talk of soft landing. There was a rate cut. People were really happy that the market was going to rebound. And then we went right into a recession shortly after. Same thing happened in 2008, 2009. Same thing happened more abruptly and quickly in 2020. So it's not uncommon at all to talk about soft landing before the rate cut and for people to get excited about it. But it's more typical than not that first rate cut is followed by a recession and a continued down in the market. Now, if the Fed sticks to their script, and that's a big if, we all know, but if the Fed sticks to their script, then rates could be held higher for longer than this new market consensus is hoping for and expecting. Right. The Fed's favorite inflation measure is what's called core PCE, and that's personal consumption expenditure deflator. And it's meant to get the inflation rate that's most important to consumers. And core, meaning they strip out food and energy. That's the rate that they look at the most. And it did decline this past week. It did decline from 3.7% year over year to 3.5%. But that's a pretty small decline, and we're still way above the 2% target. So if the Fed sticks to their script, perhaps the consensus is going to be disappointed about any rate cut coming soon. Now, if inflation does prove sticky, and it's easy to get inflation down to 3%, but really hard to get it below that, with or without a recession, that's a big problem. And yet the market consensus, this idea of immaculate disinflation, says we're going to go right down to 2% without, any recession. So that's a little tricky. Now, typically, when you look at all different rate cuts over the years, from the first rate cut to the last rate cut, typically the S&P 500 index falls between 20 and 25%. Doesn't mean it happens every time. Doesn't mean it has to happen in the future, but that's more typical. So what we would say is it absolutely matters if the Fed cuts rates next year like the market consensus is expecting. It absolutely matters. Why? Because if this consensus about immaculate disinflation, despite all the long odds against it, does come true, then that could be good news for the reasons I mentioned earlier. However, it's much more common that first rate cut is actually a warning signal, and usually the Fed won't cut rates unless they're genuinely worried about a recession coming, and usually they cut rates too late.
Excellent. Okay, so then my final question, as always, is based on what we've discussed here today, about the shift of Wall Street consensus from higher interest rates for longer to Fed rate cuts in the first half of 2024, what might investors consider in terms of adjusting their own investment portfolios for this new narrative?
Well, I remember some time ago reading what a very famous, successful investor wrote about a key part of his strategy. And it really intrigued me, and it's stuck with me. And he said that the key was to identify the false premise that the consensus believes, then jump on that trend and ride that trend, but get off and sell before the market realizes that it's wrong. So, that's pretty clever and not always easy to do. But here we have a situation where we have a very strong change in the market consensus. It believes in this immaculate disinflation. We're going to avoid recession. Everything's going to be great. And this belief could be entrenched for some time, and this could keep going up. This FOMO, the fear of missing out, could last a while. We've seen that in the past. And it is true, Fritz, as you know, that we've been raising our equity allocations quite consistently during the year, and that's been the right thing to do. However, the nuance is that we haven't just been favoring the hottest but the most overvalued stock index, which is the U.S. stock index, the S&P 500. We do have investment in the S&P 500, and that's been helping, but we've kept it at a modest level, a relatively modest level. And we've been adding equity indices that our model says is relatively undervalued, where there's still a lot more upside and perhaps less downside because they're undervalued. So we think we can add equity allocation in a safer way. And namely, that's been in Japan and in certain emerging markets which have underperformed. Also, if the rates keep coming down and the dollar weakens as a result, that's a particularly favorable environment for emerging markets. So we think that could be a contrarian investment that works well over time. Now, if we turn to the bond market, for the last 3 years, longer term bonds, meaning maturities of 20 years or more, have fallen over 50%. Not everyone realizes that. It's been an absolute debacle in the bond market. And even in the 10-year market, rates went from well below 1% all the way to a little bit over 5%. Just recently, they've come down now from 5% to a little bit below 4.5%. And everyone's excited about that, and people are jumping back into bonds. Bonds are now being very popular, and sentiment is very favorable for bonds. And it's done well in the last 2 or 3 weeks. We think that people should be careful that even though this rebound could last a bit longer, you have to look at where the fair value of bonds typically is. So one way to do that is to consider the term premium, meaning how much should bond investors expect to earn as a yield over and above inflation? And if you believe that inflation is going to come down to, say, 3%, and you want a 2% premium over and above inflation, which is very typical in a long-term average, that means bond yields shouldn't come below 5%. Already they're down below 4.5%. If you think inflation is coming down at 2.5%, then maybe 4.5% is right, but that means there's not a lot of more upside in the bond market because there's not a lot more to fall. Another way to look at it is that the fair value of bonds approximates nominal GDP, meaning real growth plus inflation. And if you think that that's true, well, last quarter growth was 5%, inflation was over 3%. Bond yields should have been 8%. Well, we were nowhere near that. However, no one believes that growth is going to stay at 5%. So even if growth comes all the way down to 1.5% and inflation comes down to 3%, then you're talking about 4.5%. We're there. So there might not be a lot of upside, but there might be some better alternatives in the fixed income market to regular long-term bonds. One might be TIPS, because you build in inflation protection and they're currently yielding over 2% plus inflation, and you get some capital appreciation on top of that if real rates come down. We also looked at money market funds and 3-month treasury bills as being investments that maybe you can do a little better than that. And so a lot of people piled into CDs and short-term CDs and treasury bills and money market funds. We think it does make sense to extend the duration a bit. And so we're looking at 6-month treasuries up to 1 year, 2-year treasuries as locking in some of those higher rates and taking advantage of the fact that rates might not go any higher and may come down a little bit. Turning to gold. Gold is testing its historic highs, and it's certainly at a level of resistance where it's gone up to that level and then fallen off again. But we're back at that level. And number one, we say it's always important for all investors to own some gold in your portfolio at all times because it's the best hedge against certain black swan events. It's the best hedge against geopolitical conflict, best hedge against monetary inflation, best hedge against currency debasement. And if real rates or inflation-adjusted rates do come down, that could boost gold further. And if we break through that level, that historic high, that could create FOMO in the gold market. So that's something that we're looking at. So to summarize, I would say that the market consensus seems to be pricing in to this rally that we can count on the immaculate disinflation, that we're not going to have a recession, profits are going to continue to grow, everything's going to be great. And we can't sit here and say that that's impossible. Right. It might be possible, but Do we think it's very high probability? And based on history, we'd have to say that would be beating the odds of what historical precedent has been. Almost every time we've been in the situation, we've delayed but not averted the recession. So we think that it's not wise to put all your eggs in one consensus in your basket, because if it doesn't come true, you could be suffering on the other side.
Excellent. Great. Thank you very much for your insight into this very important topic as we've seen the consensus shift on Wall Street. So that will do it for Steve and me for this week. I will be back next week with Eric Beagleisen, Director of Research here at 3Edge, and Eric and I will share the 3Edge recent outlook for the global capital markets, which is based on our proprietary research model. And meanwhile, Steve and I will be back the following week with another edition of the 3Edge Week in Review. As a reminder, all our videos always available on our 3Edge YouTube channel. And if you know someone who you think might enjoy and benefit from these videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.